Many people think risk means volatility. Prices move, markets fluctuate, and people assume danger. But volatility is not the same as risk. Fluctuation is not the same as fragility. True risk is much simpler. Risk is the inability to absorb shock. And shock absorption is structural, not emotional. Risk layers. Every financial structure contains three main risk layers: income risk, capital risk, liquidity risk. Each layer behaves differently, but they interact constantly. If one layer weakens, the others must absorb the pressure. Income risk. Income risk is the risk of interruption, a job loss, a contract pause, an industry slowdown, automation. Now ask yourself something calmly. If your primary income paused for 6 months, what absorbs the shock? Savings? A second income stream? Assets? Or debt? Write that answer honestly, because the structure matters more than the intention. Capital risk. Capital risk is exposure to volatility or permanent loss. Market declines, business failure, property downturn. Capital risk is not automatically dangerous. It becomes destabilizing only when structure is weak. If your stability layer is strong, volatility is manageable. If stability is thin, volatility becomes stressful. Liquidity risk. Liquidity risk appears when assets cannot be accessed when needed, even if total capital appears high. Liquidity risk often remains invisible until the moment it matters. Now let us run a simple stress test. Nothing dramatic, just realistic scenarios. Scenario 1. Income falls by 30% for 6 months. What happens to your structure? Does liquidity absorb the pressure? Or do commitments tighten immediately? Scenario 2. Markets decline by 25%. Your growth capital falls, but stability capital remains untouched. Would you remain calm? Or feel pressure to sell? Scenario 3. A strong opportunity appears. A business investment. A strategic asset. A partnership. Do you have optionality capital to act? Or would you weaken your stability layer? Pause after each scenario. Do not calculate perfectly. Just observe your reaction, because stress testing reveals exposure. Here is the core insight. Strong architecture allows calm during volatility. Calm is not emotional strength. Calm is structural strength. If you must sell growth assets to pay bills, the architecture is misaligned. If you must borrow during moderate disruption, liquidity may be thin. If one income interruption destabilizes everything, concentration remains high. Shock absorption is not about eliminating risk. It is about layering buffers. Layer 1. Liquidity. Layer 2. Income diversification. Layer 3. Balanced capital allocation. Now reflect quietly. Which risk layer is currently weakest in your structure? Income? Capital? Liquidity? Write one sentence, not a paragraph. One sentence. Because clarity begins with simplicity. In the next episode, we examine rebalancing discipline. Because architecture drifts over time. An unmanaged drift quietly creates imbalance.